So I think we have one more panelist getting mic'd up, but we can kick things off. Do we want to do some quick introductions and tell us what you're working on in the Avalanche ecosystem? Maybe we can go left to right. Travis?
Sure. Hi, everybody. My name is Travis Scher. I run a crypto investment firm called North Island Ventures. We do venture investing and we do public token investing. Prior to starting NIV in 2020, I worked at DCG for 4 years. Actually backed Amos' company during that time, so smooth transition.
Yeah, Amos originally started Colored Coins in 2012. And now we're running a Node Capital, which is a very technical fund, I would say, investing in protocols where everyone are engineers.
Hi, I'm Peter Najarian. I'm the managing partner of a group called RW3 Ventures. We are a digital asset and Web3 venture fund. Prior to that, I was the CRO at BitGo. I ran the institutions business at the original deep cold storage entity called Zappo. And prior to that, I was a long-term Wall Street guy, almost all of it in emerging markets.
Everyone, Jeff Amico, partner at Andressen Horowitz. Before this, I was general counsel of a DeFi startup called AirSwap, and now focused on investing and governance and all sorts of other network participation-related efforts at A16Z.
Awesome. Thanks for the introductions, guys. And I've been to one of those Zappo facilities in a Swiss underground bunker. It's quite an experience.
Yeah, very few people have, so.
Nuclear proof, I was told.
Yes.
We're safe there. My name is Joon Ian Wong. I'm a longtime journalist in the space, started at Coindesk many moons ago, and now I write some columns for Coindesk, TechCrunch, Business of Business. If one of my editors is seeing this, I'm going to send you that article very, very soon. So back to the topic at hand. You know, I thought we could frame this conversation first by contrasting Web3 VC and founder dynamics with kind of Web2. You know, Edith Yeung wrote a great piece recently for The Information talking about how Web2 investors are NGMI, right? They're just, you know, there's many things they do that makes it hard for them to be competitive in a Web3 landscape. And so I guess I wanted to ask all of you, you know, I thought Web3 was supposed to disintermediate stuff and we wouldn't need VCs and funds anymore. And yet, apparently, you know, more has been invested in VC and crypto last year than in the previous 10 years combined. So I guess just at a high level, do you guys have thoughts about kind of the role of VC capital allocation in a Web3 kind of world? Jeff?
I'll start off. So
yeah.
I think the role of VC is definitely changing in Web3. I think the core function still remains the same, which is to take, you know, mostly institutional money from, you know, endowments, pension funds, things like that, and to deploy it strategically into the space. Beyond that, though, everything else has changed in Web3, and now the expectations of top VCs extends into other things like research or governance or staking or providing liquidity, and so it's becoming a much more kind of holistic role that VCs are playing in this space, which I think is beneficial and ultimately plays into the hands of founders and to the communities.
So I don't actually think that the role of VCs in Web3 is that different than the role of VCs in Web2. Essentially what we're doing in Web3 is we're building infrastructure and applications that will disintermediate, you know, big institutions and other gatekeepers today, but we're still building that technology. And so what VCs do is they enable entrepreneurs to build things, right? And they give them capital, and they give them guidance, and they give them connections, and, you know, some of the big VC firms in the space, like Jeff's, give them all sorts of services, and those are things that these founders need. I think there is a different question as to, you know, when this technology is fully mature, what is the role of VCs? And that's actually, you know, going to be as much of a regulatory question as it is sort of a tech question. But From my perspective, my job is pretty similar to what venture capitalists do in traditional tech.
Yeah, to me, I tend to agree. I think that it's still entrepreneurs. Like, they have the same needs as any other entrepreneurs. They're building something new. They need help in a lot of things that traditional VCs help today in Web 2. I think that what did change is that there are different elements that are just unique to that industry. Like you mentioned, running nodes, bootstrapping the network, help bootstrap the network in the beginning, help with stuff like token economics and complex stuff that are very specific. As well as, other than the technical stuff, you have the community side, which is very, very important. So there is a need there as well. So basically, same needs as any other entrepreneur, but just with extras that are specific for Web3.
Yeah, I completely agree. And again, this is an industry that's young with a relatively young founder set. And in many cases, a founder set that hasn't really been in a building position in the past. So the notion that that an ecosystem can emerge entirely without both the financial and expertise support of a universe of professionals that have been in the business to do that in other ecosystems is I think that's a little bit naive. And we find that founders want the help. I mean, founders have bold ideas and they start to execute on a mission and they raise capital and they oftentimes get to a point after the first raise where they really need help and want help. And I think the fact that there's such a vibrant VC community that exists in crypto today is one of the reasons that you're seeing companies actually emerge and perform. The other thing that is unique, which I think is actually relatively different than Web 2, is how collaborative the VC firms are in this space. So as I mentioned, I spent a long career in emerging markets before I came into this space. That was a war, a competitive jungle every day. And in other VC and PE investing in other markets, it's hyper-competitive. That's starting to leak into this ecosystem as well, but there's still an unbelievable amount of collaboration that goes on, and the founders benefit most from that.
Gotcha. I want to go back to that Edith piece in the information, where one of the things she mentions is like, in traditional equity startup investing, right? Funds want to take 10% or more. And in crypto rounds, it's 5% maximum, or at least that's what the founders want. And so, how does this reflect on the kind of changing dynamic between founder and investor in Web3? Is this, an example of how it's more collaborative, founders have more leverage? I don't know what you all think about distribution of allocations.
Yeah, so I think in general, in our time right now, founders have basically more power. There is a lot of money out there. So this is like in general. But then specifically with crypto, I think that, first it's not dilutive as equity, and a lot of like traditional VCs, sometimes they don't really understand it, so they still want like the allocation that they are used to, right? Because they're going to be diluted and diluted in other rounds. But in this case, most of the time it's non-dilutive, or depends on the network, yeah, but so I think it does fit with smaller allocation, as well as it works for the benefit of the investor in the end, because you want to invest in a decentralized network, you don't want to control the network, and I think that's very important, and it's something that becomes more and more of the standard, to not own that much of a network, as compared to the 2018 raise of owning 25% of a network and stuff like that.
So I'll take the other side. I think that it is a founder's market for sure. There is what feels like an almost unlimited amount of capital in the market. And so when I see founders and teams that have some kind of a max allocation like 5% baked into their raise, I think they're making a mistake. I think you're supposed to pick your partners. And I think you're really well served as a founder to ask yourself the first question: do I just want capital, or do I really want help? And those don't have to be mutually exclusive, but often the highest valuation doesn't always come with the most significant help. And in almost every case that I know in my career, there will be some moment in the evolution of an entity where they will really want that help. And I really believe that it's critical from the earliest stages of your financing, if you can do it at seed, great, to spend the time to figure out who your partners should be. And really think about, was there anyone at the firm that was ever an operator in the past? In what segments were they operators? What was their track record as an operator, not just as an investor? How deep is their network in my universe and how can it help me? Like, do the work to ask the hard questions and then give them a bigger allocation and tell them you're giving them a bigger allocation because your expectations are that they're going to be there when you need them. That's the kind of relationship I think makes the most sense. And instead, what's really happening at the moment, not in every case, is that you're seeing these limitations on raises, on ownership, and nobody's then fully baked to get, like no one's really truly married, right? It becomes not a big enough bite size in a portfolio of a VC to care among many line items the way they should care. They don't feel like they were ever really asked to be a partner because they were limited. And the founder feels like it's just a free option to take in capital and, we'll see how this all works. And so I think that's a mistake, personally.
Yeah, absolutely. And you also see, angels, other founders, appearing on cap tables, right, with sometimes significant allocations. And, it's part of this much more flattened distribution of tokens, I guess, and, who really is the leader. I mean, in the kind of Web 2 world, we remember stories of, Yahoo offering Zuckerberg $1 billion to buy Facebook, right? And he calls up his lead investor, Mark Andreessen, who tells him, do not sell, right? No matter what anyone tells you. So I guess maybe this might be a good segue to Jeff. Are those moments happening still? Like, that phone call in the middle of the night to your investor for advice in this kind of Web3 paradigm? And then also, just a quick follow-up to what Pete said, I guess Andreessen was one of the first to do sort of full service, more services for a portfolio, and you have a very big war chest, obviously. So you have the capital and the help. So I'm curious to hear a perspective on this.
I think that they still happen, but it happens now much more out in the open. It's no longer a midnight phone call to Mark Andreessen. Now, these conversations tend to take place in public forums. They take place on Twitter, they take place in governance forums, they take place much more out in the open, which I think ultimately inures to the benefit of these communities. If you can now have access to these conversations, they're much more transparent. There's less, I think, of the kind of backroom dealing of, say, Web 2 and some prior eras. And so we're very careful about that balance, but I think on balance we want to be engaged in helping to build a community around the protocols that we invest in.
Yeah. Anyone else want to chime in?
We haven't done a lot of on-chain governance, and I think the on-chain governance space is incredibly nascent. There have been barely any votes that have mattered at all for any of these protocols. Most of them are well over-determined. They're not even close. I do think over time, as we kind of figure out how to do on-chain governance, as there's more kind of standards and practices, we'll get more involved in that. But frankly, like the role that we play in governance is the same role that we play, and with protocols, the same role we play with our equity investments, which is, we do our best to help the founders think about and how they can grow this protocol like it's a business using the specific knowledge that we have about how protocols grow. So I think the stuff that Jeff is talking about is at the absolute bleeding edge of what's going on here. And, I think it's going to be very interesting to see what VCs are doing vis-a-vis governance in 2 years, 5 years. But today, I think it's like hyper experimental. I don't know, Jeff, what do you think?
Yeah, I think that's still right. I think for the larger investors, of our size, I think it does become much more table stakes. I think, if you're not, let's say you invest in a new DeFi protocol that has on-chain governance from day one, and you're a big investor and you're not voting, you're not delegating, it's going to be very difficult, frankly, for governance to work at the outset in a protocol like that. And so, you need to, at the very least, be able and be kind of technically set up to delegate your tokens or to have a voting wall that you can start participating. Because just as a matter of kind of numbers, there's going to be a great deal of governance tokens that are kind of sitting on the sidelines when a protocol first launches. And it's just a matter of kind of getting those things out there, getting them kind of into the hands of people who are able to vote. Now, over time, the hope, obviously, is that, that role will be able to kind of subside and be less important. But I think especially at the early stages, if you're a larger investor, you really do have to be able to participate.
I want to take us just a moment back to the last conversation, because sometimes we're talking about Web3 and we're talking about an equity deal, right? And we're talking about a network. So I definitely agree with what you said about equity deals, because there it's still fine. But when we're talking about governance and holding too much of the pie on a decentralized network, that's where it becomes problematic. So that's what I was talking about. So I think that I would not want to hold, too much of the network in that case, because you're really in a very weird place as an investor. And I do follow about what you guys are doing and how you're trying to kind of distribute the voting, right, to minority. And doing a lot of experiment things with that. So, yeah, we still don't know how to deal with it. We try to just like Travis said, to vote for whatever serves the network, whatever serves the founders, same as we would do with an equity deal.
Yeah, well, here's a quick question, though. So when you vote on a proposal, right, how do you as a firm come to your own consensus on what to vote on? I would be curious to hear what that process is like.
Yeah, for us it's just the same discussion as we'll have on an investment, right? It's like, what is best for the network? How do we save the network? We're in touch with the founders usually, so we also understand their position, how they see things. So it's kind of like the same process as, DD protocol or a company or whatever it is.
Yeah, we're exactly the same way. We have a twice a week investment committee meeting. This would fall right into that agenda. And be handled in the same way. And in truth, if we're honest on this whole issue, we're pretty much waiting and watching to see what these guys do, because they are the leaders and they are the thought leaders in governance, in my mind, without question.
Totally. All right, the spotlight's back on you, Jeff.
No, I mean, I think it's out of necessity. This kind of ties back, Joon, to your first question. I think, if these networks are truly going to ever become decentralized and more, frankly, more egalitarian than the prior era of web services, then you not only need to kind of have the mathematics kind of in line at the outset along the lines of what you mentioned. So maybe, instead of the core team and investors owning, 70% of the company, now they own 30 or 40. And then furthermore, you need, I think, investors to take a very at least the bigger investors, to take a very proactive role in distributing some of their governance rights through things like delegation, or, at the very least, just being thoughtful and being active and helping to try to boost engagement, spur discussions in forums, on Twitter, and things like that, to really get the kind of governance flywheel going. Because it is, frankly, I think there is a huge onus on governance in these networks, much more than there is perhaps in more traditional companies. I think if they're going to ever be kind of fully governed by kind of broad communities, you need to kind of build that muscle early on.
And just to drill in a little deeper there, does that fit into, for example, your investment committee meetings, or is there some other process or workflow for that, figuring out those questions?
Yeah, so on our side, we actually built out a full team to focus kind of on the deep kind of protocol operations, and that team is in charge of staying on top of things that are happening and coming up with recommendations as to how we should vote. But I think if you get to a certain size, you really do need to build out that kind of functionality and those resources.
It's almost like having like a policy think tank, right? That does the research, gives you a white paper, and you're like, okay, this particular policy from the government, what do we think?
Exactly.
Gotcha. Going back, Pete, to something you said about, there's so much money out there, right? But it seems like the money printer is getting turned off, right? Things might change, but signs are pointing that way. So given that, I guess, that kind of macro background, how are things changing in terms of competition for deals, valuations, and so on?
So it's a very odd time with exactly that in mind. And it's an odd time because we are about to have liquidity get drained from the system. It's starting, and we'll see how meaningful that is. I think there's some limitations, frankly, on how meaningful that can be. I think that the Fed's in a bit of a trap. But you've also got one of the biggest energy producers in the world now offline and likely to be somewhat fundamentally impaired for some period of time. There's some real ugliness out there in terms of what these inflation headwinds are. This is all known, so I won't bore you. But as that's happening, there's so much capital in the system. It's so hard to quickly drain the capital in the system. It forces, just stepping away from crypto for a moment, it does force the market for hard assets and for financial assets to still have a bid, because there's pretty much nowhere else to go. Coupled with that, we've had a view for a while that this was the moment that a big universe of very savvy and financially sophisticated people in the world would wake up and no longer say, hey, I'm not sure I want to be involved in digital assets. They would start to say, hey, wait, I think I might be short because I'm not involved in digital assets. And that is a very real theme out there. We see it every day. That is, we all know the endowments and the pension funds and the early adopters, and we all know the pace of which the mega raises have happened. There is still a massive universe of untapped demand that's just waking up to becoming demand for this space for the first time. So I don't think it's going to change quickly for this asset class. I think you're going to continue to have capital. When Russia, so we're just in the middle of a raise right now, and when Putin went into the Ukraine, and we were heading towards the first close, and I thought, wow, this is really horrible timing. The Fed's got to be active. We've got all these other headwinds, and now, that's a great reason for investors to pause, and the opposite happened. I started to receive subscription docs coming in that people had been sitting on. Mm-hmm. So there's so much capital in the system, nobody knows really what to do other than to find things that they can convince themselves are in some way uncorrelated, mm-hmm. and have some longer tail opportunity to play out, which fits this ecosystem well.
So it's like money printer on is good for crypto, money printer off is also good for crypto. This is a fantastic industry to be in.
I mean, that's not forever, and that's
yeah.
not absolute, right? Yeah. But that's a unique moment that we're in because there is still a big universe, in our opinion at least, of of pools of capital that are underinvested or not invested at all.
Sure. Travis?
So I'll take things from a different angle that actually have nothing to do with, macroeconomics. I think that actually the more important forces, from my perspective as an early stage investor, are related to A, the state of the innovation, and B, the amount of talent flowing into the space. So on the innovation side, I actually think we're in a bit of a lull. I think that, 2020, we saw the emergence of DeFi. 2021, we saw tremendous advances in scaling, and, we saw NFTs go mainstream. And after that, we haven't really seen any other major advances. Now, there are some things on the horizon, and there's a ton of interesting stuff getting built, but I'm not really sure what the catalyst for the next major wave of adoption is going to be. Other than what I can say is that the amount of talent flowing into this space, the amount of incredible entrepreneurs and technical minds who are starting companies at the earliest stages is mind-blowing. And I've been doing this for 7 years, and I think the last 6 months, I'd say, we've seen 10x the amount of, let's call them A-player entrepreneurs than I've ever seen flood into the space at one time. And that actually typically happens 3 to 6 months after we kind of hit the peak in a bubble in crypto. That's kind of the path. And so, I'm not particularly bullish on the state of the public crypto markets for the next rest of the year, let's say, and that having nothing to do with macroeconomics, which I cannot predict. But I'm very excited about where things could go in 2023 because, the talent can be self-fulfilling.
Yeah, I'll just pick up on that last point. I think that's maybe the most important. I think it's almost impossible to predict short-term price movements. I think what's much more important is just the quality of talent flowing into the space. And I think it's as high as we have ever seen at A16Z. And in fact, we set up a website called Web2 to Web3, which is geared towards recruiting really top-end talent from Web2 companies to come into the space. And it is just going gangbusters right now with people who want to leave the FANG companies to jump in and start their own project in the space. I think it is probably the best predictor of long-term success, more so than anything else. We're really excited about that.
I'll just say that coming originally from Israel and being very connected to the ecosystem there, you see really a crazy amount of entrepreneurs that already exited, built billion-dollar companies, thinking about their next phase in Web3. It's just the amount of entrepreneurs is crazy. And in general, I've been in the space and an entrepreneur for 10 years, building a lot of different stuff. And I never, I think it's just the best period ever to be an entrepreneur in general, but to be an entrepreneur in Web3. So I really encourage everyone who's thinking about, entering the space. It's just a great period to be an entrepreneur.
These are all major alpha leaks, people. Also curious why you think this is happening right now. What are some of the reasons for this big influx of talent, especially from the Web2 world?
So, I think that it has to do with the fact that we finally have proved that blockchains work. With the growth of DeFi, we've actually proved that we can create software that replaces financial intermediaries. Most of DeFi is basically just this segregated world of financial games right now. It's not impacting the real world, but we've proven that it works, right? And so now people have seen that proof of concept. They want to take it mainstream. It's the same thing with NFTs, right? Where we have proven that people care about owning digital assets. This was just an idea for many years. And now, that is patently obvious to many people, right? There's a few other examples of this, but I think we have POCs, and plus we obviously have a tremendous amount of venture dollars in the space, hype in the space, and it just, it all becomes self-fulfilling.
If you think about everything Travis just said, which we completely agree with, and you're a builder, and that's who you are. You're an entrepreneur who your juice is building businesses. You can only come here, right? Everything he just described, coupled with the massive white space that exists out there, coupled with what feels like almost unlimited flow of capital right now, which is scary, I grant you that. But if you're a builder, you're definitely coming here right now, if you're paying attention.
All right, we have like 50 seconds, so let's do a rapid fire for like, let's say 3 things that you're looking at and actively wanting to invest in. Maybe we start with Jeff and we come this way.
I'll keep it to one in the interest of time. I think zero-knowledge applications are probably the thing that we're most excited about, both in the context of scaling and in the context of just enabling new types of applications that haven't really been possible on public blockchains before.
I'll keep it to one as well. I think regulation's coming in a real way, and it's a good thing, and a fair amount of that regulatory war is going to be fought on the landscape of DeFi. And I personally don't believe in the West, peer-to-peer trading, lending, derivatives, etc., exist in a way that isn't KYCable and taxable. So call it permission DeFi or whatever you want. But I think there's a huge opportunity for growth there once we get through the process of how onboarding works and can be taxable.
Got it.
Yeah, I'll say very shortly, we love infrastructure, very technical base layer protocols. I mean, I'll keep with that. There is so much to do there still on build.
Okay.
I had more time, so I'll do 3.
No.
And we can circle back. Digital identity, DeFi for real-world assets, and application-specific blockchains.
All right, guys. So ZK, permission DeFi, infrastructure, and Travis just said 3 that I couldn't remember. Thank you for listening. We're gonna do.